Joining me now is Ryan Detrick, Chief Market Strategist at Carson Group. Ryan, welcome to the show.
Good morning, and thanks for having me. This is neat to be here in person.
Yes, so great to. Yes. I know we speak with you sometimes on Zoom. So good to have you in person at the New York Stock Exchange. Momentum is building. Markets will be opening at 9:30 a.m. What are you going to be following most closely today during the session?
Yeah, you got earnings going on, right? You've got the Supreme Court going on. I think just the action this week's been interesting because on Tuesday we had that big down day. But volume was actually kind of light on Tuesday. It kind of freaked everybody out, got everybody all worried. And now here we are, we're in November, which can be strong. There's not a ton of news, I guess, is the bottom line. But, it's a bull market, and I still think people should be pretty optimistic about that.
That's right. You do remain bullish on markets, but you do anticipate, I understand, some choppiness in the months ahead. Walk us through that.
You think about it, the S&P 500 is up 6 months in a row, NASDAQ up 7 months in a row. Historically, the first, let's say, 2 weeks or so of November can be a little choppy. I wouldn't be shocked if we kind of had a catch our breath moment, but just think about this. We were up more than 15% for the year heading into November right now, right? November is usually stronger when you're actually up a lot going into it. And the last 2 months of the year, November, December, have been higher 20 of the last 21 times when the S&P 500 has been up 15% for the year going into it. So will there be a chase? We think there will be. Like 82 or 83% of fund managers are underperforming their benchmarks this year. It's cliche to say, but cash on the sideline is real. And we think any weakness will be modest and probably still an upward bias for this year is all said and done. Last comment, we're up, 16, 17% on the S&P? I don't think it's too crazy to say we're probably going to see another 20% year, which will be the third one in a row.
Historically, what have we seen in November and December?
Yeah, November is the best month on average. It's 1950, the best month the last 10 years, second best the last 20 years, and third best in a post-election year. December is usually pretty strong as well. So those are some concepts to think about. One thing I've been talking a lot about, though, the idea of a slingshot. If you're a kid, you play a slingshot, you throw it back. We were down 15% for the year back in April. Now we're probably going to finish the year up double digits. Only 3 other times, actually, in history have we seen that. 82, 2009, 2020. What matters to the listeners, that next year was higher at least double digits every single time, up 19% on average. I'm not saying we're going to 19% next year. What we are saying is the idea that this momentum we've seen after that bear market we had in April, or near bear market, it probably will continue if the economy hangs in there like we think it will.
All right, and we are in the heart of earnings season. What are you taking away from the numbers and from the guidance?
Yeah, probably similar to about every other guest you've had. Really impressive, right? I mean, over 80% of companies beat on revenue, 80% of companies beat on earnings. Guidance has been strong. I mean, we're looking at 4 quarters in a row now of 10% year-over-year earnings growth. Every quarter you come into it, kind of say, well, is this the one? Is this the one earnings are going to disappoint? And fortunately for investors, that hasn't been. I think earnings, honestly, the way to wrap this up, are justifying where we are. I know there's talk about bubbles, and maybe some of the AI stocks are a little frothy. Yes, we do not think it's a bubble. We think earnings are justifying this bull market.
All right, and a lot of Fed talk has been going on, and about 2/3 of traders are saying that there may be another rate cut in December. What do you see for the rest of the year and into 2026?
Yeah, we do think there'll be a cut in December. I know Powell kind of put a little water on that last week. That's just because he doesn't have a lot of economic data. We think there will be cuts. And the truth, again, who's going to be in charge of the Fed next May? Well, we'll see. It's probably going to be someone dovish, right? The Fed funds futures are looking for, maybe 3 or 4 more cuts next year. We think that's probably possible. And one more thing for the listeners, when the Fed cuts near all-time highs, like they just did, well, done twice so far, but they just did a couple weeks ago, or I guess last week, 21 times they've done that. 21 times a year later, the S&P 500 has been higher when they cut near all-time highs. That's just one data piece. I get it, but there is that old saying, don't fight the Fed. That one to us, if the economy hangs in there like we think it will, avoids a recession, a Fed cutting is a bullish scenario for equity investors.
And given the government shutdown and lack of data, how do you think they will make that decision moving forward?
Yeah, I mean, they know the labor market is weakening, right? I think Challenger Gray Christmas just came out today. Now, that's a very volatile one, so we're not getting too worked up about it. But the labor market is weakening, and we know that. Now, once we finally start to get the government opened up, and I fly out pretty soon, so I'm a little nervous about the airports. We'll see. I think once everybody starts getting mad about the airports, they're really going to open things up sooner. But the truth is they know they have to cut a little bit here to kind of help the labor market. I know the inflation data is not spectacular. Shelter's coming back, but services inflation is a little higher than you want. Goods a little higher than you want. But the reality is labor market's weakening. That's why they should be cutting.
All right, and given economic headwinds, market volatility, how are you advising your clients right now?
Yes, we're still overweight equities. We've been overweight equities for 3 years. That wasn't very popular a couple years ago, but now here we are, and we really think this is a global bull market. We like the U.S., yes, but around the globe, you've got but most stock markets hitting 52-week highs, all-time highs. We have overweight equities with a good amount of international exposure, specifically developed international. We think that's how you should keep your portfolio for this bull market. Look around the globe a little more than you were the last couple of years.
All right. And anything under the radar that you're looking at that you think might be a big splash?
Yeah, the fact that we just had a bull market birthday, right, the year 3, so now we're in the 4th year of the bull market. And when you look at history, last 50 years, no bull market ended in the 4th year. They went an average of 8 years. The last 5 were like 50 years. The shortest was 5 years. So people think this bull market's extended, maybe near term with the rally we've had, but to say it's a old bull market is not true. This is still a fairly young bull market, and we think this extension into at least next year with this bull market is alive and well.
All right, Ryan Dietrich, Chief Market Strategist at Carson Group. Thank you for joining us in person at the New York Stock Exchange.
This was a lot of fun. Thank you. Appreciate it.
Thanks for your insight.